Chairman, in June, the Fed decided not to cut interest rates and to take a wait-and-see approach instead. In your press conference, you said this approach was justified because, and I quote, "We will see a lot more on all of these issues in the very near term," end quote. Last week, we got the job numbers for June, and they were very strong, with the employers adding 224,000 jobs. So my question is, did the June jobs report change your outlook for whether a reduction in interest rates is appropriate in the near term?
Well, a straight answer to your question is no, but I will give you the context. We look at a broad range of data. So let's start abroad, where I think since the June meeting and for a period before that, the data have continued to disappoint. And that's very broad across Europe and around Asia, and that continues to weigh. And by the way, manufacturing, trade, and investment are weak all around the world. We have a box that talks about that in the Monetary Policy Report. In the United States, we did get a job report that was positive, and that's great news. And we had some other reasonably good news. I would say the U.S. data came in about as expected. And I would also say that let's go to trade. We've agreed to begin discussions again with China, and while that's a constructive step, it doesn't remove the uncertainty that we see as overall weighing on the outlook. So I would say that the bottom line for me is that the uncertainties around global growth and trade continue to weigh on the outlook. In addition, inflation continues to be muted, and those things are still in place.
Okay, Mr. Chairman, some economists and many market participants believe that the Fed should cut interest rates by a full 50 basis points in July, rather than a normal cut of 25 basis points. Personally, I don't see the case for cutting rates by 50 basis points because the economy is quite strong right now. What economic factors do you believe would justify taking the unusual step of cutting rates by a full 50 basis points?
At our meeting, which is in 3 weeks, we'll be looking at a full range of data. And I would just take you through the story I just told you. That'll be what we're thinking about, is the extent to which trade developments and concerns over global growth are weighing on the outlook, and also the performance of inflation. Those are the factors that we've identified, and all of that will go into our decision making.
And also, Mr. Chairman, you have repeatedly stressed that uncertainty about trade policy is a major economic headwind and is one of the factors that could lead the Fed to cut rates this month. But as we've seen under the President's, very unlikely that we'll ever get much certainty on trade policy. It keeps changing every day. So my question is, what kind of progress in trade negotiations do you need to see in order to put your mind at ease about trade developments not being a headwind, to use your term, to economic growth?
I guess I ought to start by saying that no one should interpret what I'm saying about trade headwinds as in any way a criticism of trade policy. We do not play a role in assessing or criticizing or trade policy. It's not something that's assigned to us. We react to anything that, in principle, anything that can affect our ability to achieve the dual mandate goals you've assigned us is something that could, in principle, call for a policy response. Right now, that is global headwind, global weakness, and trade developments are things that are widely thought to have that effect. That's all. So I wouldn't want to try to prescribe a specific answer, and again, it wouldn't be ours to do in the first place.
Well, hopefully we'll have some answers on trade soon, and thank you for your service, and I yield back.